energy sector. I won't delve too much into what we've seen in 2021, but some highlights just to point out. We obviously saw a very large range in the oil price. We saw Brent ranging between $50 and $86 a barrel, a lot of volatility in the oil markets, but also a very healthy recovery. We saw the world continuing to grapple with COVID. Things are certainly looking a little bit more positive as we start 2022. Middle Eastern economies performed very well with the recovery in the oil price. OPEC continued to control the markets very well and keeping it in balance. But we also saw some challenges with supply crunches in the second half of the year, price spikes, particularly on the gas side. So some certain challenges there. In the backdrop of that all, we had the US Federal Reserve keeping us guessing with what it's going to do towards the end of the year. And of course, the stock markets doing their thing. And last but not least, and again, very much a focus of today's discussions, both in the plenary session that we're going to start now and in the roundtables later on, in the backdrop and coming to the fore very strongly was the whole target of our journey towards net zero and climate targets of economies, of governments, and of companies. And that very much came to the fore, of course, at the end of the year with COP26. And one point which seemed to be made was how we still needed to rely very much on conventional energy, the lack of capex on that front, and indeed how traditional oil and gas producers were going to continue to keep that energy security flowing, but at the same time meeting their net zero targets. And that's going to be very much part of our discussions today. So I wish you all some very dynamic discussions. We have a range of experts joining us throughout the morning and in the afternoon. And without further ado now, I'd like to welcome our host, New York University Abu Dhabi, our forum host, and introduce the Vice Chancellor, Ms. Mariette Westerman, to open the plenary session for us. So Mariette, welcome. And I see you've already turned on your camera and your mic, and thank you very much, and over to you.
Thank you so much, Diala. Salam alaikum, everyone, and good morning or good day, wherever you may be. Your Excellencies, dear members of the World Energy Community, and you are a community. As you heard, I'm Mariette Westerman, the Vice Chancellor of New York University, Abu Dhabi. And it is a distinct privilege for me to welcome you to this plenary session that kicks off the 12th UAE Energy Forum. Thank you so much for joining us on Bloomberg TV and LinkedIn and other channels. It is always a pleasure for my institution, NYO Abu Dhabi, to co-host the forum with the great colleagues at Gulf Intelligence. And it is a special honor this year to welcome His Excellency Suhail Al-Mazroui, UAE Minister of Energy and Infrastructure, who will be with us shortly. We are deeply grateful to him and to the other very distinguished speakers in this session for making the time to inform us and to be with us. In the next 2 hours, we will hear from a wide array of great energy experts who can speak to the year ahead for the energy sector. And of course, few topics are more important than the energy transition to net zero carbon emissions, to which this country, the UAE, has made such an inspiring commitment for 2050. It's very exciting to us in the university. We're also very excited that COP28 will be here in 2 years, so we can play our part as a university community. So at 12 years young, this UAE Energy Forum is just 1 year older than my own institution, NYO Abu Dhabi. And I think it is fascinating to see how our institutions, the forum and the university, have evolved together over this time. More than ever, this year's edition of the forum is dedicated to the question of how the energy sector can lead and be a big part of the energy transition that is so urgently needed to ensure the future of a prosperous and well humanity and the habitability of the earth for all living things. And I think progress is really being made and in the offing. Just a couple of months ago, when we had ADIPEC, the big conference here in Abu Dhabi, I had the opportunity to speak with many leaders of the energy sector, and I was very impressed by the commitments that I heard to bold investments in renewables, even as we, of course, for the time being, absolutely also have to make sure oil production and gas production are viable and sufficient for humanity's needs. I also was really delighted at ADIPEC to hear about training and upskilling initiatives across the organizations that I spoke to. And all these leaders were helping ensure that the energy sector will be staffed by really diverse talent from across the world, and talent that is capable of finding solutions to the climate crisis. Universities, I want to say this to you, universities can be great partners in achieving these goals. And that's why we are a co-host and so proud to be a co-host of this forum. Like many universities, NYU Abu Dhabi has unique assets for propelling fair and effective climate solutions. Our first of these two assets is our professors. Our professors conduct cutting-edge research that can help us understand climate change and how we can effectively mitigate it. Their research ranges widely from cleaner desalination and more efficient building materials to mathematical and economic forecasting of what will happen to the climate, to food security and policy studies. We do all of that. Our second great asset is our extraordinary cohort of young people, talented and hungry young people. At NYU Abu Dhabi, we educate students from the UAE and 120 other countries. And we educate them to be able to lead on challenging work like this. And all of these students, I talk with them all the time, and they rightly insist that we, our generation, needs to make progress on the climate crisis now, not tomorrow. When you talk to young people, their greatest worry today is no longer COVID-19, although it's still a challenge. Their greatest worry is for their future. It is how to cope with devastating new weather patterns that we've seen, with unreliable water and food supplies, with the growing displacement of people around the world, partly due to climate challenges, and they are worried for the extinction of animal and plant life of all sorts. So our students work with their professors to develop solutions to these very difficult problems. And in doing so, they are not against the energy sector at all. That's sometimes a misconception, I think. They want to work also with and in your organizations, and many of our graduates in fact do. But what they do tell us is that they want the industry to help secure their future, just as they ask me as a university leader to help them do that. So I am especially pleased that you will hear this morning from one of these students, Rashford Bhandari, who graduated in 2019. Rashford contributed much to sustainability studies and action during his time at NYU Abu Dhabi, and he is now applying his knowledge at the Asian Development Bank, and specifically its carbon market program. And programs like that, I think, form an essential component of what will need to be a comprehensive architecture for climate policy ahead. And all of us, universities, ministries, companies, NGOs and agencies, and all of us individuals will have to step up to create these solutions together and put them into practice now without delay. The future of our humanity and planet depends on such common purpose. So with that, I wish you all a most productive conference and plenary session. And above all, I look forward to seeing you back in person with us on our beautiful campus you see behind me next year.
Thank you very much, Mariette Westerman from NYU Abu Dhabi, and again for hosting the forum. Thank you so much. If you'd like to now, thank you, mute yourself and turn your camera off. Well, we're going to get started with our plenary session now and the content on that. And to get us warmed up, as we always do, we're going to put a couple of survey questions to you all and get your take on that. So Irene, if you could please start with giving us our first survey question for the day. And there it is on your screen. You can start voting anytime by clicking one of those options. Brent crude oil averaged $40 in 2020, 71.
As panelist and not as a 10.
Sorry, yeah. Sarah, if I could ask you to switch off your camera, please. Thank you. So Brent crude oil averaged $40 in 2020, $71 in 2021. What will be the average price of Brent crude oil this year, 2022? So if everybody could please cast their vote on that one, and then we'll have a look at the result. Irene will bring that up for us. I was just hosting one of the breakfast briefing sessions a while ago, and we had Abu Dhabi Commercial Bank on there, and they were addressing how the healthy oil prices of 2021 have put some of the Gulf economy budgets back into surplus, or at least back into balance. And of course, they're all going to be very much keeping an eye on that oil price in the year ahead to try and stay that way. And there we go, got the result there. So we have $70 and $80 taking the majority of that vote. So we put that somewhere in between. We hit 75, I assume. That's a positive outlook, and certainly would put countries like Saudi Arabia and the UAE into budget surpluses and help the other GCC economies. Let's have a look at the next survey question. And again, that puts it very much on the average of 2021 in the low 70s. Now, let's really test your crystal ball skills. What would you think would be the average price of Brent crude oil over the next 5 years? So the average over the next 5-year period, closer to $60 or lower, closer to 60, closer to 80, so that should be probably closer to 70, option B, and closer to 100 barrels a barrel or higher. So between 60 and 100 is that range for the average range for the next 5 years. If everyone please cast their vote. And we'll have a look at that. Irene, if you could give us that result. Okay, again, we seem to be getting an average price of $70 even for the next 5-year average, which is a very positive outlook, obviously, for oil producers, and certainly a comfortable level, and even for consumers like India, who have said that they're much more comfortable with $70 than $80 a barrel. So let's have that third question, please. We have another one. With the global oil market returning to 100 million barrels a day in 2022, despite the commitments made at COP26 towards net zero targets. So will the global oil market return to that level? Some people argue it's touching that level almost already, despite the commitments that we've seen to net zero targets. Again, very much a theme that we're going to be discussing today. Let's cast our vote on that. Of course, we've seen the demand scenario very much asking for that oil. I would predict we're going to get a yes vote there. In the immediate term, there's been a supply crunch. There you go, 84%. So that's very much the majority of people thinking we're going to be seeing demand recovery back to 100 million barrels a day. So thank you very much, everybody, for answering those questions. And we're going to have a few more for you as the plenary session proceeds. And now it's a pleasure to welcome Mr. Rashford Bhandari, who Ms. Westerman had introduced a while ago. He is an alumni of NYU Abu Dhabi, and he's going to be giving us a TEDx presentation. So over to you, Rashford. Welcome, and please do turn on your microphone. Thank you.
Thank you, Diala, and thank you, Mariette, for your very kind introduction. Can you hear me well? Yep. Good morning, Your Excellencies, dignitaries, ladies and gentlemen. I'm delighted to be here this morning with you, representing myself and climate activists and young people quite broadly, and speaking to you about the need for the hour. Many of you in the audience might be dreading the not again. Not another climate activist who is here to undermine the role of oil and gas. Not another climate activist characterized by idealism, who doesn't acknowledge the reality of our economies and is going to scream on top of his lungs to stop oil and gas. But I'm not here to prescribe or tell you what the future of oil and gas is. All of you know that much better than I do. I'm not here to tell you about climate science and the gravity of the climate crisis. I'm hopeful that all of you are well aware of it already. I'm not here to tell you that we are well underway in a global energy transition, that we will, over time, reduce dependency on fossil fuels. I'd imagine that knowing this is exactly the case why we are here today. While it was easy for me to know what I did not want to talk about, settling on what I wanted to say was particularly difficult. For starters, preparing for this talk was challenging because I had never been part of an event where the organizing partners page had so many logos of oil and gas companies. I was intimidated of being ridiculed, of not being taken seriously, and of being simply brushed off as a youth climate activist who doesn't know what he's talking about. My first real awareness of climate change was at the age of 19, as an aid worker in the foothills of Mount Everest after the 2015 earthquake in Nepal. During my stay, I noticed that my hotel staff left the guests behind and hiked uphill for 2 hours every night, seeking shelter over the fear of potential glacial flooding triggered by the recent earthquake. My newfound curiosity about climate change gradually turned into a dedicated professional and personal aspiration. And over the past 7 years, I've worked tirelessly to advance climate action. I was initially anti-corporation, as I saw them only as part of the problem. But after working in the environmental division of a corporate firm, I had my perspectives changed. I understood how closely linked all different stakeholders are and the important role the private sector played in tackling climate crisis. Over my undergraduate years at NYU Abu Dhabi studying economics, my graduate studies in Beijing studying economics, and eventually my professional career working on climate finance in Asia and the Pacific, my outlook on climate change has expanded from naive sophomoric activism to an in-depth appreciation for the challenge ahead. I've also been anti-oil and gas, as I only saw them as part of the problem. Don't get me wrong, there's no space for oil and gas in a net zero future. I believe in climate science and the IEA's energy roadmap, which says net zero means huge declines in the use of coal, oil, and gas. It means phasing out all unabated coal and oil power plants by 2040. And despite having experienced spending many years in developing Asia, where energy poverty and lack of access to energy is rampant, I still see oil and gas as a transitionary source of energy that needs to be phased out. As the well-established quote goes, the Stone Age didn't end because we ran out of stones. The phasing out of oil and gas is inevitable, and it will end before we run out of oil and gas. But as I have grown older, I've realized that the oil and gas sector needs to be part of the solution, as the climate community cannot solve the crisis in isolation. In fact, real action needs to be taken by many of you who are here today. And there is some good precedence. In 2017, Dong sold its North Sea oil and gas business and changed its name to Ørsted to reflect its near complete transformation from fossil fuels to renewable energy. Ørsted is now widely regarded as one of the greenest energy companies in Europe. In addition to pursuing a systematic transformation of your company's business models, you have well-rounded and holistic expertise in meeting the global energy demand. You know how energy systems work, and you're well aware of the gaps that are needed to be fulfilled in meeting the global energy demand, irrespective of the energy resource being used. In particular, your expertise fits well with technologies such as hydrogen, carbon capture and storage, and offshore wind that are needed to tackle emissions in sectors where reductions are likely to be the most challenging. But there's one area that the oil and gas industry really needs to work on. Put candidly, you don't listen to the other side. And I don't think I'd be wrong to say that the climate community doesn't listen to you either. This sparked my curiosity, and I began reading more about this. And it took me no time to realize that this is an issue we all have as humans. We just don't listen to each other. In fact, there are numerous studies that show that people do not know how to listen. But listening is important, and actually is one of the most important skills we can have. Listening can enhance our ability to understand. When we listen, we communicate respect, we communicate better, and we increase likability and promote healthier relationships. The benefits of active listening are particularly important in professional development and a prerequisite for real change. The late Desmond Tutu comments about Nelson Mandela in the Book of Joy. He notes that the 27 years Mandela spent in prison were actually necessary for him to develop the ability to listen to the other side. This is my way of saying listening does not come easy. And it does not come to us naturally. It takes patience and a long time to develop. It comes together with learning to let go of our egos. It is a skill we're not taught at universities, but it is a skill we must learn. It is a skill you should invest in for professional development within your organizations. And I feel many of you will agree with me that we have reached a point where we're not able to maintain a conversation, let alone a constructive conversation with people on the opposing side. I have friends who don't talk to their parents because they work for oil and gas companies. Despite living in the UAE for many years, I don't have any friends who work in the industry. And I've not wanted to have one. I've not wanted to listen to them because I automatically think that they're wrong, that I cannot trust them, and that we cannot imagine a common ground together. And this is beyond the energy source debate. It's the same with politics. And we have time and again realized and learned the importance of engaging constructively with people from the other side. Aside from listening, we also lack the imagination to see how these two different oppositions could actually work together. In 2019, the Oil and Gas Climate Initiative held meetings with young people to lay the groundwork to engage better. That was a good start. But it's also important to create sustained plans and dialogues for the long run so we can build trust. We need to ensure that we act on what we listen to and that it is not just a photo op. It should not be about manipulating the language or branding oneself to disguise that you're actually listening to the crisis and the voice of the global climate community. You need to take notice of and act on what someone says. I believe that only then we can come with a common vision for the future. As much as the net zero vision has gained traction since COP26, as you all know, we also know that we don't have a common understanding on what net zero means. Too often than not, net zero and the definition of net zero are being tweaked to fit the interests and priorities of individuals, companies, and countries, undermining the temperature goals of the Paris Agreement. Net zero is being labeled as a carbon accounting trick. An article from the Prospect magazine summarizes the frustration of many people very accurately. It says some net zero targets are so blatantly greenwashing that they're ridiculous. So let's be honest and leave a legacy that we all can be proud of. In this pivotal decade, let's listen to each other as opposed to only enforcing our realities and our side of the story. The UAE is on the right track and has a unique opportunity to lead global action and ambition. In particular, if done well with the highest climate ambition and integrity, it can set the tone for designing net zero pathways at the earliest possible for the global community. With this, let me sum up by saying that as the host of the important COP28, the global community already has its eyes in the UAE, as it expects no less from the country. Let's therefore engage in constructive conversations, as I hope we will today, raise real and verified climate ambition, and tackle the climate crisis together as the global spotlight falls on us. Thank you.
Thank you very much, Rashford, for that inspiring presentation and talk. Many of your generation obviously tasked with this mammoth opportunity ahead that you've highlighted, and also challenges, I'm sure. Thank you very much for that. It's a delight now to welcome His Excellency Engineer Mohammed Al Hamadi, MD and CEO of the Emirates Nuclear Energy Corporation, who will be delivering the Dawn of the New Energy lecture. Your Excellency, over to you. Thank you very much.
Assalamu alaikum wa rahmatullahi wa barakatuh. First of all, good morning. Ladies and gentlemen, it's a pleasure to join you today at the 12th UAE Energy Forum. And the timing of this event is very relevant, specifically at the end of last year. COP26 was revealed that the sustainable future of our planet requires an urgent and immediate action. One of the most important themes I took from that from the discussion was the need for greater cross-sector collaboration. Without working together, it will be harder to enable a net zero strategies and deliver paths to sustainable growth and limit the impact of global warming. Most importantly, with the UAE will be hosting the COP28, we must do more. The fact that many energy sectors are represented here today reflects our commitment to working together and to make more historic transitions, which is required. With that in mind, I would like to talk about the continuous improvement of clean energy in the UAE and how we continue to stay ahead of the curve in delivering our clean energy transition. In the UAE, we have a proactive and science-based approach to energy policy that has enabled the country to lead the way toward a sustainable energy future. We were the first in the region to sign the Paris Agreement in 2016, and also recently became the first OPEC nations to commit to achieving net zero by 2050. To deliver on these goals, we have chosen to focus on collaboration. We have also implemented a net zero strategy that recognizes the advantages of multiple technologies and industries working together. By adopting a long-term and diversified energy portfolio, we have succeeded in securing greater security, stability, resilience of our electricity grid. We have also paved the way for the rapid decarbonization needed to achieve our climate goals. This approach has seen the implementation of a clean energy through creating a world cheapest solar plants and also a world-leading nuclear energy industry. Both solar and nuclear are the cornerstones of the UAE clean energy transition. But while we are investing in the future, we are also very realistic of the available technologies. Even as we diversify our energy mix to become more sustainable, the world will still need oil and gas for decades to come. This is a strategic resource that underpins much of the modern life today and will continue to be in the future. The efforts of the oil and gas sector to become more sustainable are very impressive. ADNOC's position as the world's least carbon-intensive oil and gas producer demonstrates the strategic role the sector plays in tackling climate change and provides another example of the UAE's leadership in the clean energy arena. By utilizing and investing in all energy forms available, we've chosen to maximize the UAE resources efficiently and also sustainably. At ENEC, we're very proud to be part of this UAE success story and implementing a sound and a diversified energy portfolio. And our operations has begun. We've already started leading the biggest decarbonization reduction in the history of the region. We have also achieved that with the first unit in Baraka. We are still more units to come to become operational very soon. Electricity is the most in-demand energy source today, and global demand have increased by 3% in 2021 compared to 2020. Today, we are meeting the UAE demand by generating thousands of megawatts of clean electricity, ensuring resilient and a stable electricity grid. With the 4 units, we will prevent emitting 1 million tons of carbon emissions annually, decarbonizing Abu Dhabi power sector by 50% by 2025, and generating 85% of Abu Dhabi's clean electricity. Utilizing our nation's expertise in energy and also mega projects, we have developed a program that's now the global benchmark for a peaceful nuclear energy new build in the world. More importantly, we are starting to see a new momentum in the nuclear energy from the global economies. Over the last months, countries such as US, France, UK, China has announced major plans to increase clean electricity production through more nuclear plants. We are also very glad that our nuclear program have paved the way for other nations and shown them how this could be done. And we have also proved to the world that nuclear plants can be delivered to the highest standards of nuclear safety, security, performance, and also built in a timely manner. The outcome of our power sector is a clean energy system that is stable, efficient, safe, and resilient, and supports our country's ongoing economic developments. Plus, it supports our net zero target. This will increase as the remaining units come online. As I said earlier, we forecast to generate 85% of Abu Dhabi's total clean electricity by 2025. This is only the beginning. The potential for clean energy moving forward is wide-reaching, and the role of nuclear and renewable is instrumental and is very instrumental in this, with the UAE showing the way toward a cleaner future. Today, to stay ahead of the curve, ENEC is already looking into the further applications of nuclear technologies beyond the generation, including hydrogen as a clean fuel of the future. This low carbon fuel is essential to transition to a net zero world, especially for hard to decarbonize sectors. And it is also expected to account for 18% of global energy demand by 2050. The nuclear sector, with its plentiful zero emissions electricity, and high purity steam, is poised to capitalize on this new growth market. In fact, the Baraka's 4 units had the potential to generate around 1 million tons of hydrogen per year. At the same time, the oil and gas industry is also playing an important and crucial role in the generation of hydrogen, with the plans of expansions with efforts to generate blue hydrogen through the carbon capture usage and storage already underway. This illustrates how both the nuclear and the oil and gas sector are working together to put the UAE on the path to becoming a key player in clean hydrogen generation. We also aim to be pioneers for a more sustainable and net zero future by illustrating the value of clean energy investments can make to the economy. Globally, ESG investments are valued over roughly $30 trillion, and the IEA project's overall investment will double by 2030. Last year, Abu Dhabi became the first market to recognize nuclear as a form of clean energy for green certification, opening a leading opportunity for nuclear as an accelerator for net zero growth. Through the certification, 100% of electricity drawn from the UAE's electricity grid by ADNOC is powered by electricity generated either from Baraka power plants in Abu Dhabi or the solar facilities. This also illustrates how clean electricity can support other sectors to continue to grow in a clean and sustainable manner, as well as to access ESG funding. The EU is also currently evaluating its own sustainable investment taxonomy to include both nuclear and natural gas, further demonstrating the essential role these baseload sources play in a green economy, and also the potential for future clean investment in these industries. In conclusion, the UAE has become a case study for other global clean energy transitions. We have opened the world for opportunities for our industries and economy. The result will be on display for the world to see in COP28 here in the UAE. We are also open to sharing our experiences, lessons learned from our clean energy journey so far, and also look forward to joining you today in the discussion and the deliberation throughout this forum. Thank you.
Thank you very much, Your Excellency Al Hamadi, for that presentation. Before we go on to our next panel, I'd like to, Irene, to bring up another survey question for us, please, which is asking the following. Saudi Arabia's oil minister warned last month that global oil production could drop 30% by the end of the decade due to falling investment in fossil fuels. Of course, a lot of conversation around that topic lately. Is that hyperbole or is that a reality? Is he right or is he wrong? So there are your three choices: probable, possible, or unlikely that we're going to see that 30% drop in production by the end of the decade. Let's take the votes, and Irene will give us the results in a couple of minutes. Thank you very much. Well, we're going to move on now to our international finance panel entitled Energy and Investment, Mind the Gap, Irresponsible Capital versus Responsible Capital. And by irresponsible capital in this particular discussion, we are referring to investment or investors who haven't necessarily traditionally invested in the energy markets or the oil and gas business, but yet have the funds to do so. And where is that trend going? How much are we seeing of traditional investment versus new sources of funds? And is there a risk in that? And we're hoping very much that the panel that we have there up on the screen is going to answer that question for the year ahead as part of our outlook on where is the money going and where in terms of new energy investment and where is it coming from. There we see our poll result of the question, possible. So we've got 56% of you saying that the oil minister is probably right, and 27%, quite a few of you actually disagreeing. with that. And of course, that question we're going to be addressing much more in our discussions as we go ahead. I'd like to now introduce the moderator of the next panel, Mr. Andy Critchlow, Head of News for EMEA at S&P Global Platts. Thank you very much, Andy, for joining us today, all the way from the UK. And our panel as follows: Dr. Ahmed Atiga, Chief Executive Officer of the Arab Petroleum Investments Corporation, Dr. Sara Akbar, Chairperson and CEO of OilServe Kuwait, and Non-Executive Director of Petrofac, Dr. Carol Nakhle, Chief Executive Officer of Crystal Energy, Mr. Christoph Ruhl, Senior Research Scholar for the Center on Global Energy Policy at Columbia University. So thank you very much to our four panelist guests. If you'd like to please switch on your cameras now and your mics. Not your mics, actually. You'll switch on your cameras for now. Stay muted for the time being. And I'm going to hand over to Andy now to moderate the International Finance panel for us. Over to you. Thank you.
Thanks very much, Diala, and good morning there to everyone in the UAE from a very cold and damp UK. Just to kind of frame the conversation today, energy and investment, mind the gap, irresponsible capital versus responsible capital. One of the stories that really captured my attention this week in the UK was around energy poverty, and it feeds into the financing of energy transition and how that can clash in many ways with the financing of traditional energy sources such as oil and gas, and it's around some of the struggling power utilities here in the UK. Of course, in Europe, we've had record surges in wholesale power prices, and that's driven by more record increases in wholesale gas prices. And one of the power utilities this week drew some very bad PR because it sent an email to its customers who can't possibly afford power for their homes in the UK this winter, advising them to eat ginger or in the worst case scenario, give each other a hug to keep warm. And so that's how you know, in reality, what this issue of financing energy transition and financing the production of energy actually means for people on the ground, means for you and I to keep ourselves warm in the winter. It's a critical subject that cuts to the very heart of society. So I'm really excited to discuss this today. And I guess I'm going to start, Christoph, with you. I mean, can you just kind of elaborate a little bit more on what's meant by this phrase here, irresponsible capital versus responsible capital? What is irresponsible capital and what's responsible capital?
Well, good morning to all of you, first of all, especially to the UK, where it's still dark, I guess. Let me then take on this question, plus the question, what is meant by the investment gap, right? Because both of them form our topic. I would just, for starters, probably make three broad points in that respect. Number one, warnings of an investment gap, in particular in oil and gas, and very much in particular in oil, are sort of an old story. It happens again and again, and I remember well, after prices came down 2014, when we had 15, 16 meetings and the IEA and others OPEC were really, really shrill about the oil world being about to collapse in 2019. At that time, they made the mistake of also putting a date to the forecast. It was 2019, where the gap was supposed to show up. It was nowhere to be seen. Good reasons for this. We know that in oil, investment costs follow oil prices. So there is always an amelioration, there's always a delay, which causes the cycle. We know that usually these calculations are a little bit absurd because they neglect inflation. And obviously, when you have a rig count of a rental rate of $100,000 versus one of $500,000, a 1 million investment is a very different thing. And then, so one has to take that with a grain of caution, but I'm having, can you see me? I lost the picture.
See you now, Christoph.
Okay, sorry. So one has to take that, that's the first point, with a grain of salt. Having said that, however, there is more reasons now than ever before to be conscious of the notion of investment gap because of the lack of investment in many sort of Western-based oil and gas companies for regulatory reasons and for shareholder reasons having related to climate change. That's one point. Secondly, irresponsible capital. The way I read the write-up for the session, what is meant by that is the replacement of good old IOCs, shall we say, sort of public companies, mostly based in what we call Western rich democracies, the BPs, the Shells, the Exxons, the Chevrons of this world, by some dubious trading houses or by wildcatters or by small, some may say agile, others may say irresponsible people taking over their assets. The prime example would probably be when BP decided to scale down its oil and gas and its oil investments, and they sold Alaska, the assets there, to a less known small company. All the papers, including the traditional, like the Financial Times, were full of horrified scenarios, how these guys would just increase the environmental damage, which is always inevitably connected to oil and gas production. However, this is just half of the story, because this is just a transfer of ownership. What we really talk about, the first point, is about investment. I think if we really talk about a shift in the nature of capital financing investment as an increase in productive capacity, what we're really looking at is a shift from companies originating in these rich democratic Western societies to state-owned companies originating in places where natural resources are abundant and controlled by governments. Many of them are democratic, many are not. Many of them are wary of ESG, many are not. So that kind of shift from privately owned companies to state-owned national oil companies is, I think, at the core of the title of the session. And then the third point, and this is what we need to close that story, is I think there is something missing here. We are talking now about supply developments for a very long time, and justifiably so. And again, the title of the session, The Investment Gap and Will It Be Bridged or Not, is entirely supply focused. We are, for many reasons, not all of them related to climate change, but that's not the time to get into that, probably in the decade where we will see demand peaking, at least in the oil industry. So we enter a very, very, very different world then from the world where we had this endless growth. That world of a shrinking oil market will be characterized by competition among producers for the cheapest available resource. It will be characterized by the falling apart of organizations such as OPEC or OPEC Plus, as a shrinking price just to keep exports constant forces people to compete and forces them to lower prices against each other. And that, again, will greatly accelerate the shift towards state-owned companies, because that's where the cheap resources are. And this is why you see Saudi Arabia expanding its capacity, the UAE expanding its production capacity, Kuwait expanding its production capacity in preparation of that shift. And more expensive provinces, be they Alaska or the North Sea, sort of being less important, and the less so, the faster the demand declines. For whatever reason, it will decline. So if I then take these things together, then I said, yes, there is probably a shortage of investment right now, but we should not lose sight of the fact that this just is a cyclical phenomenon. The long-term secular trends are probably less important, the shift to irresponsible capital, whatever that is, and much more important, especially in a context where production will start to fall at some point, the shift towards state-owned producers. The IEA has expected production from OPEC countries in the next, I think by 2050, to go up from today less than 40 to about 52%. And it could in reality be much more dramatic if oil demand declines faster than the IEA assumes. So I think that's something we need to factor in.
So good if you're a national oil company and you're backed by the balance sheet of a government or a sovereign wealth fund.
If you are the balance sheet.
And it's a little bit trickier, in fact, a lot more trickier if you're an international oil company and you have to address the concerns of shareholders who maybe have one eye on buying an electric car as opposed to a normally aspirated vehicle. I'm going to come to you, Dr. Ahmed, next. You know, from your position at Apicor, I mean, would you continue to invest in hydrocarbons, in oil, given all the debate around energy transition, given some of the moral hazard now associated with it?
Yes, thank you very much. And first of all, I thank the organizers for inviting me to yet again this very important discussion, and hopefully next year we'll be together. Certainly, Apicorp, as the only energy-focused multilateral financial institution in the region, with the name petroleum in its name, owned by the 10 Arab oil producers, will continue to strike the right balance in its financing between conventional and non-conventional. And I think this morning we had, most of the speakers have already alluded to the need for this balance to take place. And the empirical evidence is very much showing that this balance has to be struck and is real in that sense. Let me give an example of how we're doing it. Last September, Apicorp issued the first ever green bond by an energy-focused financial institution in the MENA region, and probably one of the very firsts in the whole world. Again, a green bond that was 3 times oversubscribed, based on a ESG framework that we have developed and was rated as advanced in terms of its impact, expected impact, and was subscribed by 93% of the investors who bought the Apicorp paper came from outside the region, from hardcore ESG investors in Europe and the US. And that was also a very remarkable outcome. This shows a very simple fact. It shows that these investors, who are, as I said, hardcore ESG, still believed that an institution with a petroleum in its name from the MENA region, owned by the 10 Arab producers, can finance non-conventional and can finance green investments, but at the same time will also play a key role in the decarbonization of the oil and gas industry. This is the right balance that needs to be struck. When we sold our paper, when we sold the story behind our bond, our green bond, we were very clear to say that we, among other financial institutions in the region, will continue to support the hydrocarbon sector, but we will support it with a emphasis and with a view of making it cleaner and greener, so to speak. And this is really how we select our investments. Let's not forget the petrochemical industry in this region and in the world as a whole is not only a source of power, but also, oil and gas is not only a source of is not only a source to generate power, but also it's a feedstock in industries that the whole economies depend on. And in this case, petrochemicals, for example, is one. So can we say that petrochemicals and all its related industries will be forgotten? Of course not. So what I'm trying to say is that we have to be realistic about this balance, and financing is the key and core prerequisite for the success of the energy transition. And this transition has to be conducted in a manner that safeguard the interests of all stakeholders.
Thank you, Dr. Ahmed. I'm going to come to you now, Dr. Nakla. Good to see you again, and welcome. I think on that final point there, I just want to kind of put that into context and get your views on this as well, because one of the concerns is where's actually the sums that are now being talked about to finance the energy transition and to keep the oil industry producing crude to meet demand are absolutely astonishing. And I know that some commentators have actually raised concerns of where the money is going to come from in the context of the bill for the pandemic. You know, the world economy has been under tremendous strain over the last 2 years, and that is continuing. Some of the headline figures I saw that came out of COP26, for example, and the Glasgow Alliance for Net Zero that was championed by Mark Carney, this confederation of banks that are committing to finance net zero projects going forward. And the figures that are being talked about are something like $100 trillion of financing required through to 2050. I mean, this is astonishing, these levels of financing that are required. On the other end of the spectrum, we have this underinvestment now, this narrative in oil, which is really feeding through directly to physical prices in many ways. I think that by some measures, last year we saw a 25% drop to around 340 billion into upstream investment. We need to get to about 500 billion to continue to meet demand going forward into 2022 and beyond. Just to put that into context, the US spends on average about 700 billion on defense every year. So these are significant sums that are going to have to, banks, institutions like Apicore, other institutions in the world are going to have to find to finance this. Is this possible?
Good morning, Andy. Good morning, everyone. So great to see many good friends back again, although virtually. Well, look, I mean, you have already touched on very important aspects, but when somebody asks me about investment gap and investment need, the first thing that comes to my mind is what drives investment. And if we go back to basic finance, you're talking about price expectations, about cost, about government policy, which tends to be forgotten. So you have lots of unknowns coming into the picture, and we're talking about supplies for the future. And when we talk about investment gap, there is a very important variable that you take into consideration to appreciate the kind of warnings that are being made, and that is demand growth forecast, so the needs that are out there. And here I have the first problem is that if I stick, for example, to oil and gas, if I look at the demand forecast for the next 5-10 years down the line, you can already see huge disparities between different forecasts. So you have the first unknown variable that you need to address to answer the question of investment gap. And there's, the price expectations. People talk about triple prices for oil prices this year or next year, when they are always possible. And mind you, we've been in these environments before. Remember 2011, 2014. What happened then? What happened afterwards? So we've been more than 10 years since, almost 10 years, in a lower oil price environment, and investment alternative is picking up. You talk about economic growth outlook, okay, that would drive demand for energy and particularly for oil and gas. But again, how is the economic growth forecast for the coming years? Are we expecting to go back to pre-COVID growth rates or not? So another important variable at ADIPEC last year, I talked about the outlook for EVs, and I was given a motion to debate that I think the majority of new cars would be EVs by 2040, so 70% or something like that. So what is the outlook for the transport sector? So as you can see, there are lots of unknowns. Now, if I go back to a point that Christoph mentioned earlier about the investment gap being an old story, absolutely, and often it failed to materialize because investors end up responding to higher prices because they are after, important returns. Because again, we go back to basic principles of finance. But if I go back to the first few years of the century, we had, a rapid escalation of prices. And that was at the back of a long period in the 1990s. You may recall that the oil industry described that decade as a lost decade because oil prices were significantly low for a very long period of time. Then we hit the new century then, and we saw a rapid escalation of prices. But that was not only because we had limited investment in the 1990s, but also we had genuine rapid growth in the economies of the BRICS, if you remember. And my question today, do we have that? Do we have a replica of what we had before? And still supply responded. We saw the development of technology, the shale technology that happened later on materialized with more supplies coming to the market. So the point I'm trying to make here is that the investment gap is much more complicated than simply saying companies are not investing, therefore we're going to have supply crunch, therefore we're going to have an energy crisis down the line. It's much more complicated and requires a more comprehensive understanding than that. Then I think about the term of responsible investment. I know that Diala earlier, she tried to explain that, but one thing came to my mind. How do you describe investment in oil and gas in much poorer nations who have nothing to build their economies on except oil and gas? And I'm thinking about Guyana, for example. I'm thinking about lots of sub-Saharan African countries. So if you go and invest in oil and gas in those countries, to help them to develop economically, to lift those people out of poverty, is your investment responsible or not? So that's another question that we have to think about. Andy, you mentioned energy poverty in the UK, although it is quite substantial in some areas in the UK, but it's really nothing compared to the lack of energy access in many of the poorer countries. And we have to think whether that, will be responsible or not. I mean, it's a big term to describe. And to build on Ahmed's terms reference to ESG, we did some work on ESG comparing different indicators by different agencies. And I tell you, it was impossible to compare the ranking between different organizations and different indices because they use different metrics. So it's still work in progress to be able to say with confidence that it is going to direct investment in certain areas or not. So again, another area that we have to keep in mind when we're thinking about the potential. And then just let me conclude on the impact on prices before we can elaborate on other things as well. I know lots of warnings are today about triple oil prices coming down the line, more expensive energy, but I think at the end markets work when they are allowed to do so. So yes, you may have price spikes, but they will resolve over time because as we all know, higher prices are the solution for higher prices. The thing today is that the higher the prices are for fossil fuel, oil, gas, and even coal, you are simply accelerating the energy transition. So this is where, for example, I see the contradiction in the Biden administration policy, where they are so aggressive on climate change, yet they are calling for lower oil and gas prices. Because if you really want to accelerate the energy transition, you need higher fossil fuel prices, more carbon pricing, which is missing from the discussion we're having. I mean, if you want investment to go in renewable energy and greener projects, think about carbon pricing. Where is that? Where is the carbon taxes and the Biden's administration plan for climate change? So again, another layer of complexity that we want to think about. And then, at the end, I want to conclude about where investment is going the most today. We had a quick look at, for example, the green spectrum of energy. And I found that the investment is going primarily not, and it used to be solar and wind if we're talking about green energy, but today investors are more interested in, if you want, cross sectors or cross applications, technologies such as battery storage. So it's capturing a lot of attention. It's still not there to solve the problem of intermittency and variability of renewable energy, but that is something that goes beyond the spectrum. And actually, I want to conclude on one last point, just to frame this conversation for further Q&A, is that remember that most of oil and gas reserves, proven oil reserves, belong to host governments and national oil companies. So simply zooming in on the investment of the private sector give us only a side of the story. And this goes back to a point that Christoph was talking about, the kind of ownership and the NOCs riding and benefiting from the situation we are in today.
Thanks, Carol. Very concisely put, and I think you make a very good point about the importance of carbon pricing and the cost of carbon in this debate. And it's something that we at S&P Global Platts have done a lot of work around, especially actually at the wellhead now, looking at the carbon intensity of different crudes and different producing fields, which I think will become a very important factor going forward in the future in how oil is priced in years to come. Sarah, I would like to come to you really as the boots on the ground. I started my career as an energy journalist in the Middle East, over 20 years ago, covering energy projects, many of them in Kuwait. And one of the things that I do see now that feeds into this debate about minding the gap between energy transition and meeting demand for oil and gas is these capacity increases that are scheduled across the Gulf. We have the UAE looking at a major capacity increase still in its oil production, Saudi Arabia looking to go beyond 13 million barrels a day of total capacity. We've got capacity increases scheduled in Kuwait, I believe, still to be achieved. Iraq wants to increase its capacity. So just in terms of physically on the ground, how do you see this in terms of projects? How much actually of this work is actually going from being just a policy statement to actually being projects being tendered and contracted and companies being hired to drill more wells and build more infrastructure?
Well, this is a very valid question because it's not just plans on paper, it is actual programs for execution in all these countries, the UAE, Saudi, Kuwait, Iraq, and these are kind of firm projects for enhancement of production. Like I said in the beginning, I go back to the point brought up by the Saudi oil minister. We do expect a supply crunch. We do, because of the lack of investment. As you know, we invest not only to capture growth, but to sustain production. Every year, we have like 5% decline in most of the fields of the world. This is natural decline. And so investments are required to capture that decline and to capture the growth as well. But what happened over the last few years that we really did not invest. Nobody invested. It's not only the national oil companies or the international oil companies, but even the national oil companies, because of the demands on the funds from the government for managing the states. There wasn't much investment going into the oil and gas. But now, I believe because of the oil price, because of what they have seen, because of all the pressures that come from emission control, from the climate change issues, they realize they need to expedite these plans to produce this oil and gas to capture the market. And within the next few years, they can see the supply crunch coming, which will lead to higher prices, which will maximize the value they will generate from the oil and gas. And that is one of the main reasons why these investments are being planned and made as we speak in all countries. Now, going back, I believe what Mr. Atiqa said is the balance. Where is the balance? Because we know if we put investments in decarbonizing and managing emissions and creating better value chain from oil and gas, then we really don't have to slow down on oil and gas production. If we can manage all the consequences, then we are in a far better place. So I think part of the plans that all of these governments see is actually investing in emission control and creating more value from the resource. And this is the other area of investment. And for many of these countries, they see it as a huge opportunity as well, because it creates many more jobs, it creates many more businesses. So a whole suite of new businesses are just coming up in carbon sequestration and carbon management, CO2 and emission control. So they see it as opportunity in the same time when you guys, see it as a big threat. And this is the thing that needs to be managed. So this is, I believe, the two areas: investing in developing the fields and maximizing the value of the resource, but in the same time, managing and controlling the emissions and decarbonizing so that you can sustain this production for as much as you can go. But these plans in many countries are firm. UAE, Saudi, for sure, they have all these plans mapped clearly with projects for execution. Kuwait, it is doing this as we speak. I think Iraq and all the rest of I think Iraq has the maximum opportunity size amongst all of these countries, and they are still in that process of putting these plans together. But for the three countries I mentioned, for sure the plans are there and being executed as we speak.
So more positive times for EPC upstream contractors, especially in the Gulf, because that's where the world's spare capacity is going to really come from over the next 10 to 15 years. I want to come back to you, Carol, if I can, and just kind of go into this issue around how some of this financing is going to work, because national oil companies, specifically in the Gulf as well, have traditionally finance projects off their own balance sheet, and they've been able to do that because of higher oil prices, because of the structure of the oil industry in the region. But that is changing now. We've got Saudi Aramco, the world's largest oil company, which listed some of its shares on the Saudi Stock Exchange. It now has shareholders concerns beyond the government that it has to address, and obviously Saudi Aramco has started borrowing money on international markets. to fund some of its endeavours. Do you see more of that happening? And we've had other state national oil companies in the region looking at debt markets to raise funds for projects, for investment and so forth. So it's opening up new possibilities that weren't previously there, say, 10 years ago.
Absolutely. So if you look at the national oil companies here in the Middle East, you can see that they have sought, debt issuance to fund their investment, but also to support to kind of a little bit compensate for the lower oil price environment. But if I go beyond the crisis, if I look at the trend, as you highlighted, Andy, over the last, for example, few years, there was another thing that caught my attention is that traditionally the Middle East has not been quite known for being very open to a private international capital. So we saw here the UAE, particularly the country like the UAE, with massive reserves among the Gulf countries, low-cost reserves, opening up more for private investment and also privatizing some of their assets, particularly downstream. So they are also using cleverly the private capital, and many companies, even though you talk about lower investment elsewhere, they are definitely keeping a very close eye on the Middle East because you have the volume and you have the cost, the low cost attractiveness that are very important. And so I see that a trend continuing. Another advantage that can also facilitate gaining more finance. Interestingly, since you mentioned Saudi Aramco, if you look at Saudi Aramco in terms, and here I'm going to widen the discussion a little bit to a bigger aspect that investors are also particularly interested in. It goes under ESG, even though it tends to be overlooked. That is the governance aspect. So if you look at the governance of Aramco in particular and the transparency aspect of Aramco, it improved significantly, even though when they sold a tiny share of the company, but that had sent a much better signal to the international community and international capital. So on balance, I see, yes, you have a more creativity among the national oil companies in the region to tackle different sources of finance. And it's actually giving them an advantage over the structure, the old-fashioned structure that has been dominant in the Middle East for many years. And it even also building on private companies, international oil companies, capital. So this is where I see the trend continuing in the region.
I think that's a very good point, Carol, and it kind of brings us also to, something else. We've talked about oil there, but if you look at what's happening in power markets in the region as well, which feeds into this energy transition, power is going to become, more important and how it's used and utilized. One of the things I never thought I'd be saying is that, Dubai Electricity and Water Authority is going to IPO. And that's one of the, I think it's a revolutionary change that we're about to see in the UAE, one of the biggest domestic power markets in the region. And that's being championed by Dubai. It's going to hit that market. It's been reported. If I can come to you, Dr. Ahmed, so DEWA, if you had the chance to buy shares as Apicor, would you be an investor? Looks a great bet to me.
Sorry, say that again.
So, given the shift to energy transition, the importance of of power markets, and the plans for DEWA in Dubai to list some of its shares, would Apicor invest?
Yeah, sure, of course. We have done that with similar investments that have come out in the market recently. Apicorp will advocate an energy transition that suits the needs of all stakeholders, as I mentioned. I think my good friend Mrs. Akbar has given very good examples of how the petroleum industry can decarbonize and can embrace the energy transition while at the same time securing the supply, not only for growth but also for maintenance, as she said. And as she also said, we as a financier are seeing clients in the region serious about both public sector and private sector, serious about introducing the ESG elements in how they operate. Our own, as a financing institution, our own due diligence now on the clients that we choose and the investments that we make rely a lot on this level of seriousness that clients have to show. So I think it's a win-win, and let's not forget that the energy transition should not be a zero-sum game. It has to be much broader than that, And this is, I think, what the challenge and the opportunities lie ahead.
Do you think that some of the financing structures for major projects that we've seen in, say, the power sector historically in the Gulf, and I'm talking about independent water and power projects, that model where you bring in international partners or international financial partners, I'm thinking things like build, own, operate, transfer, boot projects, etc. That could actually be a model going forward, in the oil and gas industry.
Sure, that model in particular has worked well. In a number of countries in the region. For example, the renewable energy surge that happened in Egypt, in Morocco, and in Jordan have relied a lot on public-private partnership financing schemes, and were very, very successful. I know Jordan as a good example for that. In the Gulf region, in the GCC, this particular model has not yet taken shape. I think, however, the more financing is needed, as was alluded in this session, new financing schemes have to evolve, and in this sense, I think the PPP financing models should happen even in the oil and gas sector, albeit probably at a slower pace, given the high capital investments that are needed and that will still require fiscal space from the countries themselves.
Christoph, I'm going to come to you, previously, you spent many years with Abu Dhabi Investment Authority, one of the world's largest sovereign wealth funds. One of many in the Gulf, huge pools of investment capital available. I mean, what role do you think that these sovereign wealth funds can now play, not just in terms of bridging this finance gap between hydrocarbons to energy transition, but also to helping to alleviate some of these tight points in terms of financing this transition in developed markets as well? Oh, you need to go off mute, Christoph.
Apologies.
No
I was
problem.
taken aback because this is actually a much harder question than most people would think, because it's a double-edged sword. A sovereign wealth fund, properly functioning and properly defined, would be a vehicle which does not invest in energy and which does not invest in its own country, because its prime function in life is to diversify and to invest for the future of a country which is already dependent on one resource or another, so invest outside. So in that sense, they probably would have to play a role in the globalization of the financial flows which are necessary for these investments. In fact, however, we know that in many countries, including in these regions, there are many so-called sovereign wealth funds, which are actually more like domestic development banks. And there, of course, their function is to invest in infrastructure and to make possible the emergence of a power sector and of other things which somebody is talking here. But
yeah, if Elias, thank you.
Which would create the infrastructure for the energy transition. Allow me to connect this maybe to one point Kara made and you made, which I think is also a bit where we have to be a bit careful. There used to be the logic everybody adhered to, which was to say, okay, high fossil fuel prices, no problem for the energy transition because they're good for non-fossil fuels. And that's probably incorrect. I mean, what we have seen over the last months in particular is that you need energy security in order to generate support for the energy transition. If you have very high oil and gas prices, if you have high power prices, you get people on the street demonstrating against that. You get people saying, we don't want to deal with this energy transition. And on the other hand, as we discussed beforehand, if you think about the investment picture, you get investment flows into hydrocarbons because they're attracted by the carrot of very high prices. So from both angles, I think one of the experience of our discussions about responsible capital investment gaps and all that should be to pay close attention to the intricacies here, that high fossil fuel prices are not sui generis a recipe for a successful energy transition incentive.
Do you, I mean, I think that's a really important point. And, we see this now in Europe because we've all seen the some of the political unrest, disquiet that's being caused by energy price inflation in Europe specifically. Outside Europe, we've seen that very graphically recently with what's happened in Kazakhstan. Do you see more of this energy price inflation causing more political unrest globally over the next couple of years if these finance pinch points aren't resolved?
You know, there are winners and losers in this world. And when you have energy prices getting too high, you get protests in consuming countries. They get them too low, you get problems, Carol pointed out, in producing countries. No? I think it is important to realize that this logic, high energy prices are good for transition, is valid only up to a point. And that's something we needed to have learned. But it's also important, I think it here would take issue with Ahmed from Agricor, to realize that the energy transition is not a win-win, not at least not if you look at the present time. It's a win-win, hopefully, over the very long time horizon. Currently, it is a cost all of us have to pay that in the future, the planet remains a livable place. We should be very clear about this is going to be very, very hard. And this means it's going to be very, very expensive. It's not, you know, this all of a sudden we create green jobs, everybody's better off. That's not how it will work.
Sarah, I mean, we're coming to the end of our session now, and this has been a fascinating session. Thank you, all the speakers, for your comments and input to this session. I'm going to give you the last word here on this, because I think that's a very important point from Christoph. I mean, the region has grown in prosperity from production of oil and gas, but it's been a double-edged sword. What do you think that the new economy built on energy transition and low carbon economies, what do you think the opportunities and the risks are for the region in that? Oh, your microphone there, Sarah.
So I'll just take you back to the opening speech by the alumni student on his passion for green and for change and his resentment of oil and gas. So this type of expression from the youth has never been in this part of the world before. This is the first time we hear this tone, this type of, coming from the youth. So in the West, in the US and Europe, over the last 20, 30 years, what has happened is the young people, the intelligent young people that we would like to attract to our industry in order for us to be able to provide a better service, to execute our work efficiently. We've been deprived from the best talent because they went into other businesses, into the technology, into various companies. Now, but in this part of the world, we were immune from this. Everyone wants to work in oil and gas. But there is a shift. And this shift is this integration of this Middle East with the rest of the world. So you see the trends happening in this part of the world, similar to what's happening in the US, especially because the world has become a much smaller world because of technology, connectivity, and all of that. Now, so the social aspects that were never an issue in this part of the world are becoming an issue, and they will grow with time. And they will impact the policy decisions made by many governments here on how do we actually tackle this. But like I said, in the same time, when we see this as a destabilizing risk, but in the same time, it's a huge opportunity. Because like you see now, we have a couple of companies from the region who pioneer into the renewable and new energy, and they go, they become international, like Aqua, like Masdar, like these companies. So there is a whole area of opportunity that is evolving, that is captured because we do have currently, we still enjoy having enough revenue from the oil and gas that we can direct into this and create this new world. So social impact, the youth attracting of talent is an issue. It will become a bigger issue, I guess, as we grow into time, because this is exactly the issues faced in the countries where we're ahead of us. But truly, this part of the world now is more becoming a developed part of the world. They are acting like the developed part of the world, and it is integrating slowly into the same kind of thinking, same kind of opportunity for funding from international companies, becoming truly international developed areas of the world with the same kind of issues, same kind of. So this is how I see it really going forward.
Well, that's a great point to end on, Sarah. Thank you very much. I think that we've pretty much stuck to our timing there. Oil and gas helped transform the Middle East, created vast amounts of prosperity, certainly in the Gulf region, and energy transition hopefully will create the same number of opportunities over the next 50 years, and let's hope it can be financed. So thank you very much for your time. Thank you very much, Gulf Intelligence, for the opportunity to moderate this panel, and I wish you all a great conference for the rest of the day. Thank you.
Thanks very much, Andy from S&P Global, and thank you to our panel. And please do continue to listen through to the session, but you can turn off your cameras now and mute yourselves. A lot of points made there, many key takeaways. The last of which Sarah just reiterated a point that Carol made earlier. The region really is transitioning to a new model. It's opening up to international investment. Public-private sector funding is all needed. The ESG element, as Apicor pointed out, is becoming very much part on investors' minds. But the reality is also that NOCs and traditional oil and gas producers need the revenues today. They will continue to have to produce oil and gas, but in a cleaner fashion, and that indeed that revenue will help to also fund the transition and to fund new industries and new technology. So we don't see an end to that either. So it's not a zero-sum game. Many points to take away there. I'm not going to repeat all the ones I took away, but thank you everyone for listening and for joining. And we're going to move on to our next session now. Irene, if I could please have the survey question. We do have a survey question to lead us into that. And we're going to be talking about China. Of course, we've been talking a lot about production and investment. We haven't really mentioned consumers a lot, except for the point that we have to keep energy affordable for the developing world as well, of course. And so there's our question on China, that its oil imports, of course, registered their first yearly decline last year since 2004, since their record began. And does that signal then, looking forward, the start of China demand leveling off and plateauing, like many developed countries? Is that going to be a permanent feature, or was it just a one-off in 2021? And I'm delighted. So if everyone could please vote on that, and I'm going to do so myself. And we'll see the result there in a couple of minutes. And that leads us nicely into our interview with Mr. Xavier Chen, who is the president of the Beijing Energy Club. Welcome, Mr. Chen. Thank you very much for joining us. And I'm going to hand over to Sean Evers, managing partner at Gulf Intelligence, who will conduct the interview. And there we see our survey result, and I'm sure Sean can maybe perhaps ask some commentary on that. Thank you very much. Over to you, Sean. Thank you.
Okay, well, good morning. Thank you very much, Diala, and welcome, Xavier, to join us. I suppose I'll kick off very quickly, Xavier, on the actual result of this survey. Does 2/3 of this room have it wrong? They don't think this is a plateauing. They don't think this is a leveling off. Maybe it's wishful thinking for all of us here in the Middle East. China's going to keep buying all the oil we can produce. Your thoughts on the result?
Yeah, thank you very much. It's very interesting. Thank you, Sean, for the invitation. I also extend my greetings to my former colleague, Christophe Roux. I listened very carefully what he said, very interesting. Now, I voted for the yes question. China oil demand is reaching plateau or peaking for a number of reasons. I will quote only 3 of them. First one is macroeconomic prospects weakening. This is not the only Xavier Chen's opinion. It's the central government's economic policy decision-making meeting on the 8th, 10th December last year. It recognized that the demand, domestic demand is weakening. Growth perspective is also weakening. And also there is a growing supply chain disruptions. So these 3 aspects combined together actually gives less, stronger growth, I would say, in the Chinese economy. China achieved 3.2% growth, the only large economy positive growth in 2020. Last year, they achieved around 8% because the number is not published yet. So this year's
as high as 8%. I thought I was thinking more like 6, but
many experts estimate that China achieved 8% last year.
Okay.
But the official number not published yet. For this year, 2022, they downgraded to 5%. But then also Goldman Sachs just published a new estimate. The Chinese demand this year would be 4.3. Another aspect of government policy is very interesting. If you watch China very carefully, the government now put more emphasis on stability and security, less focus on growth. In the past, when China has a problem of growth numbers, they just stimulus, put the stimulus packages. But now, where's money? Government does not have much money to stimulate economic growth yet. So more and more focus on stability and on security of employment, of actually domestic issues. Second, and then of course, part contributing to the weakened perspective is the deteriorating international environment that everybody knows.
So what do you mean by that, deteriorating? Are you talking economically or the political relationships? Or? Political
relationship with the United States, and also these trade wars, between China and the US and also other countries. So this is the first reason that I'm less optimistic about the continuing oil demand.
I mean, we're seeing at the beginning of a year, usually there's many issues. This is probably the first year in 2 decades, maybe, that we start a year with China being an uncertain demand center. Its economic outlook is in the unpredictable box. And of course, it's pretty much shut off during the period of COVID because they've maintained a sort of COVID zero policy. From the point of view of the outlook for this year ahead and the management of COVID, how significant is that in terms of its impact on the economic growth of China? Just simply managing COVID, lockdowns, no tolerance.
Yeah, whether you agree or you do not agree, I really do not agree that this is the way to manage the COVID. But this COVID becomes a political issue. China wants to absolutely maintain this zero COVID policy to ensure 2 major events this year. One is the Winter Olympics in early February. And then second is the successful Party Congress in October. So before October this year, it's unlikely that China will become normal as any other countries in the world. So this would mean that all the more and more restrictions, and today you have Xi'an, you have also Tianjin, maybe more cities will be locked down and restricting demand for oil in terms of all the transportation means. So this, I would say, is the second reason. Maybe you want to ask other questions related to my third reason, Sean.
Well, the question I was going to follow up on was there's the idea of that this is being managed, right? That the Chinese national government is managing this equation. Obviously, they're managing COVID, but they're also managing the economic slowdown. But it would appear over the early winter, at least, that they in some ways lost control, because we did see power shutdowns, blackouts, a real energy crisis in China. What was the cause of that? Was it because they lost control of this managed economy? What are the issues that emerged then that we still need to pay attention to in this year coming?
Well, China experienced last year widespread power shortages. So this is essentially due to shortage of coal. 80% of Chinese power is still generated from maybe not 80%, I would say 70% of power is from coal. And then there was excessive efforts to close down the coal mines. There is also a political issue with Australia that caused the disruption of Australia exports to China. So Australia volume dropped down. There is also a domestic power pricing issue that caps, the power price of coal-fired power plants where coal prices went up very high. So reduces the incentive of power generators to generate electricity. So these three reasons combined were actually causing a lot of power rationing and disruptions. So what would be really interesting, you ask what to watch. In energy transition sphere, I would say, watch what China is going to do. We just, in the name of—
on that point, which I was going to come to, Xavier, and please go ahead, but I just wanted to make the note that the Chinese president didn't show up to COP26 in Glasgow. There was a big question mark, and I think remains as we start this new year. Is China committed to the energy transition?
Well, President Xi Jinping did not go there, I think simply because he has announced everything that needs to be announced, has nothing new to announce. China is already in the implementation stage instead of talking stage, I would say. But then also during the implementation stage, they realized that there were a lot of problems as well, like power shortages, like excessive control of energy demand by provincial authorities. There was a race to reaching net zero by the provincial authorities. So they resort to dramatic measures to cut supply. So then what's really interesting, I invite audience to watch the Chinese communique of the last December central government's economic policymaking meeting. And it says we cannot win the climate change war within one battle. We have to pace the phase down of coal-fired power based on the availability and the reliability of alternative energies. So these are very powerful statements saying that, showing that China puts back the supply security ahead of decarbonization. And then also—
Go ahead.
Also, say from operational research perspective, I'm an engineer, so I have been doing the operational research in my research career. Reducing CO2 is an objective function of an operational research equation. But then this operational research equation is subject to a number of constraints, with boundary conditions. And then in the past 1 year or 2 years, China tried, I think also other countries also tried to minimize the objective function, which is CO2 emission, but forgot the boundary conditions or constraints. So these constraints are energy supply security, continuing growth of economy, employment, financial security, all kinds of things that you name it.
Absolutely. I want to just make the note for everybody listening, about 200 people or something plugged in, that if you want to post a question to Xavier, please put it in the chat room now about the outlook for China in 2022. Xavier, on the point of some of the bigger challenges to growth, you have said that you think China's oil demand at around 14 million a day may be leveling off. I'm wondering how big a factor in that analysis is demographics. The fact that the country is a very older demographic, the population is starting to possibly shrink. What influence, although that's a big wheel of time, but I'm wondering from your analysis, what are those two things together, the impact of demographics and energy demand, and that we might be in a moment of change because of that as well?
I think demography affects oil demand in the long term. But my point, or my belief, that Chinese oil demand has reached a plateau or has peaked either in 2020 or 2021, because we do not have the number of 2021 yet. I would say around the 15 million barrels a day, 14.5 or 15 million barrels a day. And I've already quoted the two reasons. One is, this deteriorating macroeconomic perspective, deteriorating international environment, and COVID control. But then also there is a substitution taking place, massive substitution taking place. In 2020, China sold 1.3 million EVs. Last year, 3.3 million EVs.
Electric vehicles.
Electric vehicles, yeah. So this trend of substitution will continue, reducing dramatically the road transport.
On a last question, given all of these issues, how should OPEC and OPEC Plus, if you were advising them, consider, I mean, we've lived with an OPEC strategy of the last decade or more, based principally on that China would be the destination for the incremental demand growth. Is that era over? Should OPEC adjust its basic strategy?
Well, that's, all what I said is my own opinion. It does not represent the Chinese NOCs of government. Yeah, but I would say that we should revise the hypothesis that the Chinese demand will continue as it did in the past 10 years. It may have reached already a plateau. So, but that's on oil demand. Gas demand will continue. Last year, we do not have number yet, but the preliminary estimates, the Chinese gas demand reached around 12%. Growth is around 12%. And I believe that China still have room to double the gas demand in the next 20 years. So gas is a new focus, not only for domestic Chinese oil companies, but there will be also a new source of demand to OPEC countries and also to neighboring countries around China, like Turkmenistan, Russia, Myanmar.
Okay, well, I think, unfortunately, Xavier, we're going to have to wrap it up there. One could talk about China for a very long time because it is of such an important place for the world, obviously, but inevitably for most energy and oil and gas coming out of the Middle East, coming out of the Gulf, anyway, is heading in that direction. And what happens there is very, very important to us. But Xavier, thank you very much for your time today and joining us. Xavier Chen, President of the Beijing Energy Club.
Pleasure. Thank you.
Thanks very much, Sean. Thank you very much, Mr. Chen, for joining us. Sean, please do stay on the screen. We're going to move on to our UAE National Energy Industry panel entitled Building a UAE Roadmap to Reach Net Zero. I'd like to introduce the two gentlemen who will be joining you for that discussion. His Excellency Yusuf Al Ali, Assistant Undersecretary for Electricity, Water and Future Energy Affairs at the Ministry of Energy and Infrastructure here in the UAE, and Mr. Hatem Al Musa, Chief Executive Officer of the Sharjah National Oil Corporation. So gentlemen, if you'd like to join us, switch your screens on. And we have a survey question for everybody ahead of this session. Irene, if you could put that up on the screen for us, please, regarding COP 27 and 28. If we can have that question up. And it is asking, Egypt and the UAE will be hosting COP27 and COP28 respectively over the next 2 years. This will finally deliver a seat to the hydrocarbons industry that has long been barred from the climate solutions table. Do you agree or disagree with that? Will it give them a bigger voice, and have they indeed been barred from that discussion so far? So agree or disagree? Spotlight will be on the region to host those discussions. And Sean, I'll hand over to you now. Thank you very much.
Thank you, Diala. And last but not least in this plenary session, two very distinguished gentlemen who are at the heartbeat of the UAE energy sector. His Excellency Yusuf Ahmed Al-Ali, now at the ministry, but previously one of the founder visionaries of Masdar, and of course Hatem Al-Moussa, CEO of Sharjah National Oil Corporation, doing great work and developing new gas reserves in Sharjah. Your Excellency, let me start with you and just kick off with the essential point of the UAE target for net zero. I know we've talked about this before. On this occasion, I would like to, so there's a big agree there, I suppose, whether by default or design. You know, if Sultan Al Jaber, for example, is the chairman of COP28, the hydrocarbons inevitably, and by coming to the region, it seems an inevitable outcome. What they do with it, what we do with it, of course, is the challenge and the opportunity. But Your Excellency, for start, I'd like to ask, we announced the COP26 UAE net zero for 2050. I would welcome what you would describe as some of the sort of foundations to that roadmap. What are the low-hanging fruit for the UAE to meet its 2050 net zero target, which was announced only a few weeks ago in Glasgow?
Good morning, good afternoon. Thank you for inviting me to this event. Let me start with what UAE did over the last years when it comes to reducing our carbon footprint. As we know, UAE was the first nation in this region that announced ambitious renewable energy programs. I'm speaking about 2006, 2007, when we, at that time, when we put the 7% target for the UAE, for the renewable energy in the UAE. After that, it evolves to become a 24% target, and this is what we are heading in the next couple of years. UAE have a mix of clean energy sources that starts with the nuclear energy that is providing an important part of our renewable
which we heard earlier today from His Excellency Al Ahmadi, doing great work, amazing developments there.
So the nuclear really plays a very important role in the reduction of our carbon footprint. Besides that, we have almost 6 gigawatts of solar energy, almost half of it operational, and the other half in the way that and will be operational in the next few months. So this really puts the UAE in the forefront of clean energy and really have a significant impact on our carbon footprint. Besides that, we are doing also different activities, and I'm proud to say that UAE is in the forefront of adopting sustainability and carbon reduction technologies. We were the first who built the carbon capture project, Riyadh, where we are capturing 800,000 tons of CO2. We are also the first nation in the region that is building waste-to-energy projects. In fact, we have 2 waste-to-energy projects that are under construction. One of them will start operation soon, maybe early this year, and the other one will start over the next years. So all this put UAE in a very good position when it comes to really thinking and having an idea on what needs to be done to reduce further our carbon footprint and ultimately to achieve the net zero by 2050. Besides that, it's very important also to highlight that in the UAE, we are doing a lot when it comes to clean energy projects, but also we are doing a lot in reducing our carbon footprint in our industries and in our oil and gas sector. The UAE, the carbon footprint of the barrel produced in the UAE, it has the lowest carbon footprint. And we also the massive announcements by ADNOC. First of all, we had announcement of the carbon capture project, where we have the current capacity of 800,000 tons that will grow up by 500% to reach around 5 million tons of carbon dioxide capturing every year. Another important project also, the interlink of the electrical connection of all our offshore production hubs. It will be connected to the onshore, and this itself will allow us to use clean energy in all our operations, whether onshore or offshore in the UAE. I'm talking about the oil and gas consumption. This is put UAE in the forefront and make us ready to further reach, to further reduce our carbon footprint toward the net zero by 2050.
I mean, clearly, Hatem, there is some fundamental pillars in which this net zero roadmap can be built. I'm wondering from your perspective, how can we leverage greater coordination within the 7 Emirates that make up the UAE? I know we have talked before about how useful it would be to have a UAE-wide natural gas grid, for example. Your thoughts on how the region, as the country, as in all of its parts, can leverage in order to get to that net zero?
Thanks, Sean. And I just want to say that I'm glad that at the beginning of the forum, we had an activist give a few words about this, which I hope we would see more of this in the future. We don't want this forum to be a one-sided forum,
Absolutely.
Just oil and gas industry rather than the whole thing. Because at the end of the day, the solution or the way to net zero involves everybody, not just the oil and gas sector or the environmentalists. On your question about the coordination between the different Emirates on achieving net zero. Now, of course,
and sectors, obviously, but yes, the whole, not just ADNOC and Abu Dhabi, but actually across the whole the country.
Yeah. Let me step back to the question itself of what is net zero.
Yeah.
If you ask different people in the street what's net zero, the few that answer you tell you that they have heard of the expression will have completely different answers from each other. Some think that net zero is that all power generation is generated from clean energy, when in reality, net zero for a country means that the whole country is producing net zero carbon emissions, which means all of the transportation sector, all of the industrial sector, all of the power sector, everything that uses energy at the end is netted out to zero. And it's a really a formidable challenge for any country, no matter how advanced it is, to achieve this. And yes, we've heard quite a few countries in the world, including the UAE, stating their intention to reach net zero by 2050. But we're yet to see the roadmap to achieving this for any of these countries, including the most advanced Western countries in Europe or something in this arena. So to achieve that, it requires everybody's work, but it also requires a huge action plan and roadmap to achieve this. And we're yet to see, of course, the details of this for the UAE, never mind the rest of the world also. So to achieve that, of course, it requires the collaboration between all of the energy players within the country and all of the sectors within the country that you consume energy. It's not just the production of energy, but it's more really the consumption of energy. So Sharjah National...
addressing that point that I made in the introduction, the idea of a nationwide gas grid. I mean, you're building an underground natural gas storage in Sharjah, that could be leveraged and utilized in other parts of the country. I mean...
Yes, of course. gas is going to be a main transition player in and on the way to achieving net zero. And of course, making hydrogen to replace gas eventually at some time in the future is part of the roadmap. And all of the infrastructure that's required to achieve that will have to play a role, including gas storage. Because at the end of the day, to be able to deliver energy reliably 24 hours a day, 365 days a year, you must have all kinds of infrastructure to achieve that delivery, including gas storage, energy storage, hydrogen storage, and the infrastructure to transport it, and the infrastructure to consume it. And that is everyone to participate in this.
Your Excellency, we saw at the beginning of this year or the end of last year, the UAE government announcing, I think it was 40 new pieces of legislation, 40 new laws, big changes happening in the country. In the context of the march towards net zero, and I'm wondering, are there what are the sacred cows, if you like, what are the big gestures that the country can make moving towards COP27, 28 that will really signal a firm commitment? Do you have any in plans, for example, lifting all subsidies on power and water, that type of thing?
I would like to highlight that the UAE already in a good position in order to see what needs to be implemented to achieve the net zero. And this is the effort that will need all the stakeholders to be together. And this is what we have today under the umbrella and leadership of the Ministry of Environment and Climate Change. We have the representatives, all the stakeholders that will work together on the plan. So we announced our net zero. Immediately after that, we've seen different announcements happening, and from the ministry side, we announced our roadmap for the hydrogen in the UAE. And hydrogen is envisaged to be a very important element that will allow the UAE to reduce the carbon footprint. So hydrogen can be used as a substitute of natural gas in different ways. It can be used for the industry to create different products. Also, it can be used as a fuel in the natural gas mix. The one comment I want to do here about the gas network in the UAE, we have nationwide natural gas network. So the gas produced in ADNOC, southwest of UAE, of Abu Dhabi Emirates, is being used also in Fujairah, the north of the UAE, and the eastern coast of UAE. So UAE has very good infrastructure when it comes to electrical interconnection, gas interconnection, and also water interconnection.
So what are the big next steps? I mean, hydrogen is a bit of a time journey to when it's really going to move the dial. In the meantime, obviously we've got the nuclear. We had Mr. His Excellency Al-Mahdi on earlier. We've got the sort of curtailment in terms of maybe on the consumption side, the decarbonization of ADNOC and so forth. What's the next big item, the next big piece that in hosting COP28, the eyes of the world will go, oh yeah, UAE, they really made a move on something X since they got this COP opportunity?
At the end of the day, it's a plan for 2050, and the plan has to have in mind this long term 2050, and because technology today doesn't exist, and nobody have clear plan on what needs to be done in order to achieve 2050. Immediately, the low-hanging fruits for us is to successfully operate our nuclear plants. This will have a huge impact on our carbon footprint, expand further on our renewable energy program, expand further in our waste to energy plan. All this together will have significant impact. However, going beyond that need to be studied very well. We are in discussion we have discussion with different entities in the UAE, the production of hydrogen and export of hydrogen. However, at this stage, I repeat, nobody has clear plan on what needs to be done.
What about the point I mentioned, lifting subsidy on power and water consumption at a consumer level, on a corporate level?
But this is I would say is not accurate entirely, because
not entirely, but it's still there.
Most of the segments, so we don't have subsidy for gas. We don't have subsidy on natural gas.
No, but on power consumption.
We don't have, and most of our power consumption in the UAE is not subsidized. So okay. Just a small segment that probably has subsidies, but most of the consumption in the UAE doesn't have subsidy. But to be accurate, at least still the UAE without subsidy, the price is very affordable, very competitive, because we don't have taxes on this consumption. This one, and
that's coming, right?
I cannot answer this, but today our price, most of the consumption that we have.
The right answer is no, by the way, but that's I think all things are possible now. Hatem, your thoughts on what? I mean, on the point of hydrogen, and we have a question in the chat room. Can the ministry do much to help mandate UAE green hydrogen as cost competitive? Because really the blue hydrogen idea is there. Clearly there's gas, there's an idea, but to make green hydrogen even economically viable, it's possibly going to need some heavy lifting on policy. Your thoughts on
that? Both green hydrogen and blue hydrogen are going to be the way of the future. But today, they are not competitive with gas. For blue hydrogen, for example, you are making it from gas. So all of the process downstream of the gas to turn the gas into blue hydrogen is extra cost. For green hydrogen, it requires two things to make it competitive. The capital cost of making green hydrogen is very intensive. But also at the same time, you need power to make electrical power to make green hydrogen. And you need very cheap electrical power to make it. So if you look at today's prices, for example, at the moment, I'm a gas person, so I'm going to use the million BTU as the unit of energy, which is the common price. Today, let's ignore today's prices, spot prices for gas, but historic prices have been in the range of $10 to $15 per million BTU. For green hydrogen, today's price is about $40. And for blue hydrogen, it's the gas price plus 7. So we really have to make significant advancement in the technology to make green hydrogen affordable. And I think it's doable. I think we are going to get there, and we probably might be able to get there within 10 years. We've seen how much solar energy has reduced in price over the years. More than 85% reduction in the price. So green hydrogen should probably follow suit and achieve that. Primarily also because it is using clean energy or solar energy to do that. The $40 price for green hydrogen is based on a 6 cent per kilowatt hour price. But we've seen in Abu Dhabi being able to achieve less than 1.5 cents. If this price can be achieved everywhere and even achieve lower price, hopefully with time, that would significantly reduce the bill. Also, the capital cost for making green hydrogen is about $18 per million BTU, and it's primarily because the electrodes are very expensive and they have less than a 5-year life. So that technology has to be significantly improved, where you like double the lifetime of the electrodes, half the cost of them. Eventually, green hydrogen could easily become less than $15, or maybe even less than $10 eventually when you get there.
Well, let's just give His Excellency. Let's just give His Excellency the last word on that point. Your Excellency, will the UAE provide subsidized electricity to make UAE green hydrogen cost effective? I mean, you were one of the pioneers in developing the solar, which started out being totally out of the money and over 10 years became the most cost competitive form of power supply in the UAE, in the world nearly. What about hydrogen, green hydrogen? Is the government ready to subsidize the electricity for making green hydrogen work?
I'll mention my opinion, Sina. I will not mention the UAE opinion. I think it took us a long time to go away from subsidy. And I don't think it's wise to start thinking again going to subsidy. Technology, we need to support R&D. We need to support creating the legal infrastructure to make the projects happen. But the projects need to prove itself. The project needs to be economical. It needs to prove its visibility in order to happen. I think subsidies are from the past, and we need to go away from it, and we need to think about more sustainable measures and schemes to support green projects to happen other than subsidies.
Well, maybe subsidy is the wrong word. I mean, in terms of investment, we've seen like the US government gave $500 million to Elon Musk at the beginning of Tesla's development, and that was an investment into technology development, I suppose. But listen, we have to wrap it up there. Your Excellency Yusuf Ahmed Al Ali, really great to have your insights today. And Hatem Al Moussa, CEO of Sharjah National Oil Corporation, thank you so much. The roadmap to net zero, we're all on it together. We look forward to working together over the years ahead. But Diala, it's up to you to close out the session. Thank you.
Thanks very much, Sean, and thank you, gentlemen, for that. And indeed, we're on the road to net zero, and we have some roundtable sessions which will delve further into that, starting at 12:30, which we're all going to move on to. One is looking at the road of gas towards the road of net zero. Another one will be looking at digital solutions. Again, there's a session on addressing the balance between energy security and energy transition, and also how oil and gas E&P will transition in a clean way, again, towards this net zero goal. So we look forward to all of us joining those 4 roundtables. And it doesn't end there this afternoon. Just as a reminder, at 3 p.m., we have an interview with Ed Moores, who is the MD Global Head of Commodities at Citibank, on his outlook for the energy markets for the year ahead. And then we have an excellent session on geopolitics for the Gulf at 4 p.m. So please do continue to join us throughout the afternoon. And I'd like to thank everyone again for joining us for this plenary session as we move on to our round tables at 12:30. And just to leave you all with one more survey question that we'd like to get your opinion on, and I'm going to ask Irene to put that up for us. Thank you. And again, another thank you to all our partners on the forum there on the screen, and in particular to our host, NYU Abu Dhabi, for today. And there's the last question. We haven't talked about OPEC much today, as per a change, but of course they play a big part in the energy transition story as well, those producers and the decisions that they make. And there's the question for everybody: can OPEC sustain its supply agreement with non-OPEC countries in the year ahead after all the non-OPEC states reach their full capacity in 2022? If they haven't already, there's been a lot of question marks on capacity within OPEC, and the argument that only 2 or 3 of them have that to spare at the moment. So yes or no, can this OPEC, non-OPEC, very successful partnership so far continue into the year ahead? We'd love to get your views on that. Thank you. Otherwise, we have about 10-15 minutes for everyone to have a coffee break on their own turf, and look forward to seeing everybody at the round tables at 12:30 p.m. Thank you again very much for joining us, everybody, and we look forward to seeing you in the next few minutes. And there's your answer. Yes, positive, 72%. Full confidence in OPEC and OPEC continuing to cooperate at least and to sustain their agreement. Thank you very much, everybody. Thank you to all our guests and our panelists for joining us, and our audience, and we'll see you shortly. Thank you.